Welcome to the video. To begin, we will explore why even disciplined savers with over $1.5 million by their early 40s can stall their progress. Then, we will analyze the hidden risk of cash drag and the steps to deploy excess cash strategically. Finally, we will wrap up with practical frameworks, diagrams, and a short quiz to solidify your next moves. First, we will set the context of how this portfolio was built. Next, we will define cash drag. Then, we will outline specific steps to optimize cash, followed by tax-efficient allocation and HSA strategy. Afterward, we will visualize a path to $7 million. Finally, we will end with key takeaways and a call to action. Before proceeding, please note this presentation is for educational purposes only and does not constitute personalized financial, tax, or legal advice. Circumstances vary, and you should consult a qualified fiduciary advisor and tax professional for recommendations tailored to your situation. Now that we have the disclaimer, let us set the stage. The profile here is a disciplined saver who has consistently maxed 401k or 403b contributions, contributed to Roth IRAs, maintained almost no consumer debt, and carries a low-interest mortgage around 3.5%. This mix enables rapid wealth accumulation and puts early financial independence within reach. Continuing from the context, this flowchart highlights the behaviors that produce the current success: maximizing workplace retirement plans for over a decade, consistently contributing to Roth accounts, keeping a low-rate mortgage rather than prepaying aggressively, and maintaining virtually no consumer debt. These steps collectively led to more than $1.5 million by the early 40s. Next, let us define the main threat: cash drag. As balances grow, many high earners become increasingly cautious and hold large cash balances for potential purchases like real estate upgrades or car buyouts. Once liquidity exceeds a robust 12-month emergency fund and clearly defined short-term needs, the excess cash can reduce long-term growth and delay financial independence. Now let us quantify the impact. Suppose there is $210,000 in excess cash beyond a 12-month emergency fund and specific short-term needs. As a hypothetical, growing at 4% for 5 years results in about $45,500 of growth, while 6% yields roughly $71,000. That difference is about $25,000 in just 5 years. Over 10 years, the cumulative gap becomes significantly larger. These figures are illustrative only, but they show how prolonged cash holdings can materially delay financial goals, especially after inflation. With the cost of cash drag in mind, let us move to action. First, segment goals by time horizon. Second, fund a full 12-month emergency reserve in a high-yield savings account or short-term treasury bills. Third, if a major purchase is 3 to 5 years away, hold only the near-term down payment and closing costs in a high-yield savings account or certificates of deposit. Fourth, for 1 to 3 years, prioritize capital preservation using treasury bills, a CD ladder, short-term treasury exchange-traded funds, or short-term TIPS. Fifth, for 3 to 5 years, mix ultra-short or short-term bond funds with treasuries to maintain low to moderate volatility. Sixth, for 5 or more years, use diversified equity or balanced index funds to target higher growth. Seventh, automate transfers to reduce decision friction and rebalance periodically. Question 1. If a home upgrade is 4 years away, what belongs in the high-yield savings account right now? Options are: A, the entire projected purchase cost; B, only the down payment and closing costs; C, nothing, invest everything; or D, only 12 months of expenses. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, only the down payment and closing costs. The rationale is to keep funds you must access soon in safer cash equivalents, while deploying the remaining excess capital into conservative, low-volatility vehicles to combat inflation and pursue modest growth. Next, let us optimize taxes through asset location. In the taxable brokerage account, emphasize low-turnover exchange-traded funds and consider municipal bonds for fixed income if you are in a higher tax bracket. In pre-tax retirement accounts, such as a 401k or 403b, place tax-inefficient assets, like higher-yield bond funds or REITs, to shelter their distributions. In Roth accounts, prioritize assets with the highest expected growth, since withdrawals can be tax-free under qualifying rules. Be cautious using target date funds and taxable accounts due to potential capital gains distributions. Coordinate your allocation across all accounts to minimize taxes while maintaining your overall risk level. Now let us compare target date funds with a customized allocation. Target date funds offer simplicity and an automatic glide path, and they work well inside retirement accounts. However, they can be tax inefficient when held in taxable accounts. A custom allocation allows precise asset location across taxable, traditional, and Roth accounts, supports tax-aware placement of bonds and REITs, and facilitates rebalancing through contributions. The trade-off is that it requires periodic monitoring and maintenance. Moving on. Let us strengthen the health savings account strategy. The HSA offers a triple tax advantage. Contributions may be tax-deductible, growth can be tax-deferred, and qualified withdrawals can be tax-free. Consider investing the majority of the HSA balance and paying current medical costs from cash flow if feasible. Keep organized records of receipts so you can reimburse yourself later, allowing the HSA to compound for decades. Treat the HSA as a dedicated, healthcare-focused retirement resource. This timeline illustrates the journey from the early 40s to the mid-50s. It starts with approximately $1.5 million invested. It then tracks ongoing maximum contributions to workplace plans and Roth accounts, consistent HSA contributions invested for growth, and the gradual reduction of excess cash via staged deployment into treasuries, short-term bonds, and broad market index funds. The diagram also marks periodic rebalancing and acknowledges that returns vary year to year. Major purchases are funded from the appropriate near-term buckets without disturbing the long-term allocation. The end state targets around $7 million by the mid-50s, contingent on continued discipline and market performance. This table summarizes a three-bucket cash strategy. The safety bucket is for 0 to 12 months and uses high-yield savings, treasury bills, or money markets. The near-term goals bucket is for 1 to 3 years and can use a CD ladder, treasury bills, short-term treasuries, or short-term tips. The growth reserve is for 3 to 5 or more years and may include ultra-short or short bond funds and diversified index funds. When possible, place bond exposure in tax-advantaged accounts to improve tax efficiency. This mind map presents the decision process for deploying excess cash. Starting from the root, the first branch is time horizon, which guides instrument selection from high-yield savings and treasury bills for less than 12 months to diversified equities for 5 or more years. The second branch is account type, which drives asset location, low-turnover exchange-traded funds and municipal bonds in taxable, bonds and REITs in pre-tax accounts, and high-growth assets in Roth accounts. The third branch is risk tolerance, adjusting the blend of treasuries, short bonds, and equities accordingly. The fourth branch is automation, using monthly transfers and quarterly rebalancing. All of this sits on top of a prerequisite 12-month emergency fund. Question 2. Which is generally most tax efficient to hold in a taxable brokerage account? Options are A. A high-yield bond fund with frequent distributions, B. A broad market index ETF, C. An actively managed fund with high turnover, or D. A REIT mutual fund. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. A broad market index exchange-traded fund. Many index ETFs are relatively tax efficient due to low turnover and the in-kind creation and redemption mechanism that can help minimize capital gains distributions compared with mutual funds or high turnover strategies. These are the core lessons. First, cash drag becomes a significant risk after achieving large balances. Second, maintain a 12-month emergency fund and only near-term down payments in cash. Third, deploy the remainder based on time horizons using treasuries, certificates of deposit, short-term bond funds, and diversified index funds. Fourth, optimize asset location across taxable, traditional, and Roth accounts. Fifth, invest the health savings account for long-term healthcare needs. Finally, automate contributions and rebalancing to reduce behavioral errors. In summary, you already have a powerful savings engine. The next step is to eliminate cash drag and redeploy excess liquidity to appropriate vehicles by time horizon. Align each asset class with the right account type to reduce taxes. Execute through automation, periodic rebalancing, and tax reviews. This repeatable system compounds the advantages you have already created. Before we close, if you found this helpful, please like the video, share it with a friend who might be sitting on excess cash, and subscribe for more actionable wealth-building content. In the comments, share how you plan to deploy your cash and what timeline buckets you will use next.